Hi, my name is John Hanlon, and I'm the author of the website www.johnhanlon.com. And today, I'd like to speak with you about portfolio diversification. If the stock market crashed today, would you be wiped out? Question I'd like you to ask yourself. Many people would be wiped out if the stock market were to crash today, but not me. And I'm going to tell you why in a minute. Now, here's another question for you. Is your investment portfolio truly diversified? Now, many people are going to say, yeah, I think so. And I'm going to tell you that they really aren't. Okay, why is that? Well, it's a fact that approximately 96% of the United States retirement portfolios are limited to traditional market investments. Now, what are traditional market investments? They're things like stocks, bonds, and mutual funds, largely. Now, so as a result, retirement portfolios are very vulnerable to market risk, which, if it's dramatic enough, can wipe out an individual's lifetime savings and put retirement plans on hold. And some people will never recover and won't be able to retire, perhaps ever. So what does that mean? It means that many people, if not most, think that their portfolios are diversified, but they really don't have a clue. Now, I know that sounds harsh, okay, but if you can grasp the concept, get your arms around this concept that I'm about to present to you, it can be life-changing, and it can protect you from financial disaster. And it's also the reason that I said at the start here that I wouldn't be wiped out if the stock market crashed today, because I am truly diversified in my portfolio. So what is true diversification? True diversification of your portfolio is a means to increase your expected rate of return and at the same time reduce your portfolio's volatility and risk. And a lot of people think, well, if you're going to be willing to accept, great reward, you also have to be willing to accept a great risk. That's true in some cases, but there's ways to mediate that, and I'm going to explain that now. Okay? Modern portfolio theory. Okay? Been around since 1952. Modern portfolio theory, MPT. Modern portfolio theory is a sophisticated but simple to execute investment approach that was first developed by Professor Harry Markowitz of the University of Chicago back in 1952. And in 1990, he actually received a Nobel Prize in economics for modern portfolio theory. And this has become the framework upon which institutions like Harvard and Yale universities manage their endowment funds, which is hundreds of millions of dollars, and some of the richest people in the world construct their investment portfolios around MPT theory. It was Markowitz's position that portfolio risk could be reduced and the expected rate of return on the portfolio could be increased when assets of dissimilar price movements were combined. A diversified portfolio of uncorrelated asset classes, which means assets that move in different directions based on the market. Some are going up, some are going down, just based on the market conditions. In a great year, they all move together. Okay, I mean they all go in the right direction, but you got to have things that move contrary to. You have to have investments that move contrary to other investments, and this can provide the highest returns with the least amount of volatility or risk. Now, a lot of investors are under the delusion that their portfolios are adequately diversified if they're invested in various stocks, okay, mutual funds, bonds, and international stocks. While these are different investments, they still are in the same general asset class, and they have similar price movements, and they generally move in concert with each other. So for proof, you can go back and take a look at the last couple stock market crashes, and you'll see that these type of investments in the traditional assets they fell like dominoes. I mean, they all went down. Okay, the market took them with it. True diversification, according to MPT, is the addition of alternative assets in your portfolio alongside traditional asset class investments, because they move independently from one another. So I'm going to repeat myself here. Approximately 96% of U.S. retirement portfolios are limited to traditional market investments. You now know those to be stocks, bonds, mutual funds, essentially. And although the inclusion of alternative assets is increasing, it has a long way to go. And you've probably been wondering all along, what the heck are alternative assets? And I'm going to tell you in a minute. Let the suspense build. Now, as a result, retirement portfolios are very vulnerable today to market risk. And if it's dramatic enough, it can wipe out an individual's lifetime savings. And again, 96% are in that boat. More consideration, therefore, needs to be given to true diversification and the incorporation of alternative assets, non-correlated asset classes, into their retirement portfolios to hedge against market risk. So ask yourself, are you truly diversified? And I'm going to challenge you to take control of your investment portfolio. Don't just let some stock market guru manage it for you. Know if you have. Are you diversified? You now know what that means. Do you have alternative assets in your portfolio? And here are some examples of alternative assets. And I focus at first on real estate because more rich people have been created with real estate in its various forms than any other type of investment. And my personal favorite at the top of the pyramid is land development projects. And the reason for that is a typical land development project done by a professional will increase the value of land by 300 to 500%. Okay, that got my attention. I hope it got yours. To find out more, go on my website. Okay, and you'll get an earful. But it doesn't have. I don't have the time to do that today. Others are raw land, commercial real estate, residential real estate, tenancy in common investments, otherwise known as TICs, real estate investment trust, otherwise known as REITs, trust deeds, where you basically are a lender. You take the role of a lender and lend money to a borrower, and you hold the paper. Okay, and they pay you interest on your money. Tax liens, tax lien certificates. You can buy houses and property for pennies on the dollar if someone is in arrears on their taxes and won't or can't pay. Precious metals like gold, silver, and platinum are alternative assets. Precious gemstones, commodities, wheat, soybeans, oil and gas, hedge funds, private equity funds, that list goes on and on. There are a lot of alternative assets out there, and you should do your homework on these. And I really hope that you take this to heart, because I think it's a shame for people to be thinking that they're safe and they're not. And hopefully this will help you avoid pain in the future. And I just wish you good luck and all the best.